The S&P ended yesterday looking fairly strong, although we do notice some patches of red on the board, notably Nvidia down more than 4%, as well as Tesla down around 3.9%. Now our focus in today's episode is going to be on Amgen, which as we can see is down more than 11% in the pre-market, which will take it right to its 52-week low and possibly even lower depending on the market reaction. So is this an overreaction by the market? Why is it in fact faltering down? And should we consider adding to the portfolio? Bearing in mind, currently the yield is at 3.06%. This will only get higher as the shares have decreased. So let's take a deep dive. First thing, very important to understand, why has the company started to fall? And as we can see, probably something at a first glance you would believe to be positive, but the obesity drug that they have released caused around 20% weight loss after a year with no plateau. Now that seems to be very positive. 20% after all is a significant amount to lose, especially within a year. But the issues that have arisen, although we should be specific and say the issues that Wall Street believe are arising with this, is that it wasn't as good as they believed. Funnily enough, they were wanting to see around 25%, and they did miss by 5 percentage points. Now that at a first glance does seem like a very large overreaction just due to the fact that they were expecting a larger amount of weight loss, and it is only a fairly small difference. So it looks like it could possibly undervalue a possible overreaction and maybe a great time to consider buying. In fact, when we did take a look at this company around 30 minutes ago, it was down even further, so perhaps the market is starting to buy the dip. Now over the last 10 years, it is up around 75%, so you would have underperformed the S&P during this time. And as we can see, the forward PE, which will only go lower as the shares do decrease, were currently sitting at 15 before this news broke. Double buy signal and a hold from Quant. Let's dive in. First thing we do want to highlight briefly is their earnings. Now we can see the next quarter will be released on February the 4th, although that is yet to be confirmed. And their more recent quarter, Q3 2024, 558, they beat the analyst targets by 47 cents. And on top of that, the revenue was up around 23.2% when you compare it to the same quarter last year. And they also came in line with analyst expectations at 8.5 billion. When we take a look at the next few quarters, well, we can in fact see 3 out of the next 4, so 75% are anticipated to be an increase to the earnings per share. And when we look back over the last 4 quarters, we can in fact notice 3 or 4 have been beat, 75% track record. Good to see, as we've just mentioned, the more recent quarter was a very sizable beat, and if that does give you faith in management and their historical forecasting accuracy, well, they anticipate over the next full year earnings per share 20.64, lowering the forward P down to 14.24. Now just some points to highlight from that investor presentation they released a few weeks ago. The first one we've already highlighted, but good to see that they have mentioned 23% on a year-on-year basis. That is very strong, especially for a company in this industry, not something that we typically see. And they mentioned 10 of those products that they have sold saw at least double-digit sales growth or better. Very positive. And in fact, for dividend lovers, we like to see this, an increase of 6%. We'll look at the dividends in more detail, but that is above the 4% inflationary target that we do set on this channel just to keep up in line with inflation. We can also see the number of products that they have sold was up around 24%, and that is also driven by volume growth, so selling quite a significant amount, 29% more. And for those that just want to see the breakdown of their revenue, well, it does look fairly even at a very first glance. There's the general medicine, there's the oncology, inflammation, as well as rare diseases. We then move on to the actual results. Now, this is a comparison against the same quarter last year. Top line revenue, as mentioned, up 23%. What's interesting is that we don't get to see the gross margin, so we will cover that shortly as well. But what we like to point out, whilst their revenue is up around 23%, cost of sales is up around 28%. So actually their costs are increasing at a faster rate than their revenue. And they also highlight that here. In fact, 17.4% of their cost of sales in relation to revenue. That is up, not a massive amount, but nonetheless, we would like to see the opposite effect, where sales are increasing at a faster rate than their costs. Bottom line is up double digit, 13%. That is great to see. And we also notice the earnings per share up 13%. One thing though that we will look in detail, as we usually do on this channel, is that their shares outstanding have increased, so they have been diluting your position as a shareholder just over the last year. Finally, in terms of the guidance, nothing too shiny to show here in today's episode. Their revenue, 33 to 33.8, is what they are anticipating for the full year. They've effectively narrowed it from the previous quarter where they released the guidance. We can also see the same in relation to the earnings per share, so not too much that we do want to discuss on that. Now let's look under the hood of the company. Firstly, dividend safety, 74, does look to be safe. Like to see that. We'll cover these two models, but as we did see, they have increased their dividend at 6% on a year-on-year basis. 5.6 to be exact in December 2023, which tells us we are anticipating another increase over the next few weeks. When we take a look at the dividend safety, it was reaffirmed just a few weeks ago, and as always, safe score indicates a dividend cut is unlikely. Now, in terms of the key metrics, remember this is from the Great Recession 07-09. No dividend was paid back then, so no comparative data. Negative 3% recession sales, above the average of the S&P's negative 12, and they massively outperformed in terms of return, minus 19%, the S&P negative 55. Definitely one of the best we have seen in terms of a recession return. This company has also increased those dividends at a very attractive rate on a historical basis. In fact, 16% on average year on year. That is very nice, and we can see 12 years of increasing those dividends on a consecutive basis. Now, in terms of the valuation, this is based on the forward PE, and we notice the blue tunnel is the expected share price. Right now, this is based on the closing price of yesterday. It does sit in the middle. That is reasonable valuation, but as the market does open, we anticipate this coming below that into severe undervaluation. But remember, we don't look at any of these models in isolation. We will conclude when we run it through our own valuation process towards the end of the episode. We then move on to dividend yield theory that states a company is undervalued when the current yield sits above the 5-year average. Right now, it is sitting in line, but as we said earlier, the yield will go up based on this drop to above the 5-year rolling, which will be an undervaluation signal, and that same comment is mirrored on the forward PE. Yes, right now it is in line, but as we said, when the share price drops, this will be lower, thereby giving us a double undervaluation on these two models and the severe undervaluation that we saw above. We also notice it is trading at a discount to the overall healthcare sector P of 15.9, and we'll compare the sector median numbers as well against Amgen. We then look at the free cash flow payout. Remember, on this channel, free cash flow over earnings, which is susceptible to manipulation by management through accounting. Then we want to see below 50% for biotechs. Remember, the reason why we have these essential targets is to give us faith management are able to offer very attractive dividend increases. And what we noticed, it's been increasing over the longer term, 62% in 2023, which is maybe why we got the single-digit increase as opposed to the double-digit we have seen historically. Now, over the next 12 months, it is anticipated to come down to 41, so we would like to see at least at a bare minimum high single-digit increases from this company. We then move on to the free cash flow per share, where we want to see increases consistently over the longer term. Very inconsistently, granted it has increased by 30% over the last 10, but on a year-on-year basis, we don't get that consistency. Nice to see though, over the next 12 months, it is anticipated to increase to around $21.80. We then move on to sales growth, 3 to 7%, in fact 3 to 4 at the bare minimum, just to keep up in line with inflation. Looks to be there or thereabouts over the longer term, trading to a month at 21%, as we just saw on the previous quarter as well, looking very good. So we do believe 2024 should be a fairly strong year for this company. In terms of numericals, we can see below around 40% from 20 billion in 2014 to 28.2. Again, trading 12 months showing us a very strong year anticipated in 2024. And shares outstanding, what we want to highlight here, companies that return excess cash to investor pockets through those share buybacks, something we have seen them do over the last 10 years, although in the more recent period it has slowed down. And just look at the increase from 23 on the trailing 12 month and from what we've just seen in the more recent quarter. So we do hope this is just a one-off and they're not going to continue to dilute the shareholders over the longer term. ROIC, one of our favorite metrics, 10% or more, or 25 for this industry. Give us faith, management are able to effectively allocate their capital, something we don't see that often in terms of consistency, and it has dropped to around 10% on a trailing 12 month. maybe something you're happy with, maybe 10% is something you can get comfort with, but also we do look at a margin of safety towards the end of the episode, so we can factor that in. We then look at operating margin, where remember, not just the minimum is what we want to see of 25% for biotechs, but also operating efficiency, margins increasing. That is, after all, what we call a high quality company. Revenue increases, margin increases, very inconsistent in the way it goes year on year, and just over the last few years it has started to decrease, so again, something we should bear in mind. And even though the free cash flow margin has decreased over the longer term, 26% still looks good, as well as 19% on a trailing 12 month. We just need to ensure that this isn't the pattern moving forwards, where both operating and free cash flow continue to falter. We then move on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. We want below 1.5 for biotechs, and for those that are new to this metric, it tells us the number of years it would take the company to pay off all of their debt net of cash on hand. And remember, it correlates to dividend safety, balance sheet strength, very high in 2023. Now it is expected to come down, but not much movement over the next 12 months. So again, something to bear in mind. Ideally, we want to see consistency well below this number, and we will also take an in-depth look at the balance sheet shortly as well. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each, as well as the upside that Wall Street themselves see over the next year. And on top of that, you'll be able to grab a newly released copy of 29 undervalued dividend stocks that Wall Street themselves believe right now have the most upside in the S&P 500. So click below, you can sign up and start reading straight away. We then move on to insider ownership that sits around 0.69%, with around 1.24 million worth of sales over the last year, although we note no movement in Q4, no movement in Q3, so you would have to go to around Q2 where we see 663,000 worth being sold. And when we take a look in detail who these insiders are, in fact you'd have to go to the 3rd of May where we see the SVP sell around 2,000 shares. What we would say, firstly, this is outdated. We're talking about going as far as back as May. And the second thing here is insider selling we don't necessarily believe to be a bearish signal. They sell for many reasons, personal and financial. Now, institutional ownership around 77%, 7.2 billion worth of sales over the last year. During the same time frame, more than double the amount of buys, and we can see the same being true by quite some distance in the more recent quarter. So institutions clearly do like this company. They're buying more over the last year. They're buying more over the more recent quarter. Remember, do your own due diligence and never follow institutions or insiders blindly. Now let's take a look at the income statement. We have already discussed their top line revenue growth over the period, but we didn't highlight the bottom line net income. And when we do take a look, we can see the story to be told is one that is familiar with this company in terms of inconsistency throughout. Their bottom line of 5.2 billion reported 10 years ago has only got a marginal increase into 2023 at 6.7 billion, and we can see on a trailing 12 month it is possible that this number will come down lower, where it sits at 4.2 billion. So lots of considerations to have. And then we move on to the balance sheet, where we want a quick health check, and this is something based on the net debt to EBITDA that didn't look too impressive. So their cash over the long term has in fact been increasing by quite a significant amount, 27 billion in 2014, 9 billion in the latest quarter. But very important to understand, we don't look at any one of these metrics in isolation, and we do compare it to their total debt, both numerically and directionally, which, as we can see, in fact, their debt has skyrocketed just over the last few years, doubling from 10 years ago at 31 billion, where it sits right now at just over 60, significantly higher than that cash balance. So again, lots of considerations. That is why ultimately at the end of the episode, we do apply a margin of safety. And we also want to highlight their cash from operations, which, as we can see, over the last 10 years hasn't had the greatest in terms of movement. The cash they were getting from their operations were 9 billion in 2014. Now it sits at around 8.5. In fact, it has lowered. So these are just purely things that you do need to consider, and it's not just relating to this company. You should consider this whenever you are analyzing any others that you want to buy. Now, in terms of the gradings, they get a D- on valuation, which is interesting because when we look at the P on a non-GAAP basis, 15 versus the sector median of 21, which means right now if you are buying this company, you are getting a discount which will only grow as the company has now dropped in the pre-market. And we can see relative to whatever valuation metric you use, some do say that they are trading at a premium, others, as we can see, at a discount. Then we move on to the growth grade where they get a D-. Now revenue year on year, 21%, better than the sector of 7.3. Moving forwards, marginally better at 9.2 versus the sector of 7.9. However, the thing that lets this company down is that the earnings over the next 5 years are anticipated to grow by only 5% when the sector overall sits at 10.92. We then draw your attention to the profitability, which does look good at an A+. Gross profit margin comes in at 61%, marginally better than the sector at 58%. Their bottom line at 13% looks a lot better than the industry around negative 4.5%, as well as their cash from operations, 7.3 billion, whereas the sector median looks to be burning cash at negative 15 million. Now, quick recap for this part of the analysis. Double buy from Seeking Alpha and Wall Street, hold from Quant, D- on valuation, D- on growth, with an A+ on profitability. Now, two more things before we jump into the valuation. First one, comparing against others in the industry, similar size biotech companies, as we can see here. Over the last 12 months, including reinvesting dividends, total return, you would be up 15%. As we can see with the market going to be opening very soon, this will come down. And we can see when we zoom in over the last 5 years, they are one of the worst performing, up only 46%, which is fairly terrible over that period. Over the last 10 years at 131%. Again, bear in mind, this past performance has no indicator on the future. They could perform better, but they could also at the same time perform considerably worse. Now, just for those that want to see the comparison against the S&P, well, S&P's outperformed over the last year. No surprises, outperformed over the last 5, and again over the last 10. Reason why we show you this is just so that you do have faith when you do pick individual stocks that they will be able to outperform the S&P over the longer term. Otherwise, you could consider a low-cost ETF. Now, let's jump into the intrinsic value, which we have here today. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $324. How we got this? Well, it's the average of these 4 models. Let's take a quick look now. First one, Graham's valuation, stock ticker symbol, earnings per share, long-term growth rate, AAA corporate bond yield, giving us our first intrinsic value, $214, which comes out as overvalued. But remember, we don't look at any of these models in isolation. We then have the multiples valuation, companies that we saw in a similar sector and size, average P multiplied by the EPS of Amgen to give us a very large undervaluation signal. We then move on to the dividend discount model with the average growth around 21%. We've got a lot more conservative at 5.5, also a little bit lower than last year's 5.63% increase, giving us another undervaluation signal, 2 for 1. And then we get to the DCF, free cash flow year on year, growth rate moving forwards around 8% in line with analyst targets. With the discount rate, we have the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, another undervaluation signal coming in at $324 today. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether that is for Amgen or any that you do desire. So 255, as always, we like to use an MOS. We start at 10%, execute on that if it meets our golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that, well, a buy at $292. Then we keep going till it's near the current trading price. And we can see in today's episode is not at the 25% level just yet. You're getting at least 20% up to around $260. With Wall Street very bullish in their forecast, $343 upside of 35%. Now, if you believe the market has overreacted to the news, then this could be a great time to effectively buy the dip, or maybe you believe this one is going lower, or maybe just there is another reason. Do let us know below. As always, give us your thoughts. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are notified as these videos drop. Don't forget to sign up to the free weekly newsletter below and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.